Welcome to Beyond Wall Street, presented by Arixa Capital, where expert investors make their unique investment strategies easy to understand. I'm your host, Jan Bresky, and today I'm talking with Juan Alva of Pelham S2K, and we'll be discussing the strategy of lending to businesses backed by private equity firms. Juan Alva, it's great to have you as a guest for our interview series, and nice to see you.
Nice to see you, Jan. It's a pleasure to be here today.
I wanted to start by focusing in on our audience, and they're always very interested in learning about new investment niches, especially in the private markets. Why don't you tell us a little bit about the kinds of investments that you're making?
Sure, I'd be happy to do that. We're in industry agnostic in our investments, so we'll look at deals in a variety of different areas, but we predominantly focus on business services, healthcare, and franchise businesses. And in that latter category, I can give you an example that probably a lot of people know about. We invested in a company called Planet Fitness. We provided the debt financing for a private equity firm to acquire that business initially. We grew our debt facility to allow it to go from 14 units to build new units and acquire others, and to get to about 42 units by the time that we were refinanced out as it did a strategic deal. That company is still growing today and doing very well. And so, those are the types of businesses that we like to support. It's really companies in the lower middle market that need growth capital, and we're able to provide debt and some equity to help support that growth.
Great. So using that example, you provided debt financing. Were you the only debt on the company, or was there more than one lender, and where were you in the capital stack?
Sure. So the vast majority of the deals that we do are what's called unitranches. Almost all of our portfolio companies are unitranche investments. And what we do there is we find a deal, we'll partner up with a bank typically, and then we'll divide up the debt stack, if you will, into two pieces. It's one single debt facility, one single set of documents. So the equity sponsor likes that, the company likes that. They have to make one wire, one payment when interest is due. But we're able to partner with a bank to take, let's say, the first part of the structure, the first half, and we'll take the bottom half. And so that's the way that we can not just provide the full financing need for the business, but we're also able to get the returns that our investors expect from our investment capital.
Okay, terrific. So let's walk through that. What's the typical range of the whole loan, the unitranche, including the bank portion and your portion? What's the dollar range for most of your loans?
Sure. Most of our loans will go up to $50 million between us and a bank. And to give you a sense of how we divide it up, let's say a transaction is $25 million. Maybe we'll have the bank provide 60% of that, or $15 million, and then we'll provide $10 million. The company will make one interest payment, as I mentioned, but the bank will take a lower return, and so we will take what's remaining, and that's how we generate the higher yield for our investors.
Okay, great. So I know, Juan, from our prior conversations that you also use some structural leverage within your part of the investment as well. So using your example, it was a $25 million loan. You had a $10 million piece of that loan, and what percentage of that $10 million piece is coming from you and your investors, and then where does the rest of it come from?
Sure. So the way I think about it is on an overall fund basis. What we do is we raise capital. We're an SBIC fund, small business investment company. And so what we'll do is raise private capital from our investors, and then we will apply for leverage from the SBA. And the SBA will give us up to 2-to-1 leverage. So if we raise, let's say, $50 million of private capital from our investors with 2-to-1 leverage, we can operate and invest like a $150 million fund.
I see. So if I were to look at the whole loan that you made to the business, I can almost think of that as having three layers. One being the bank, which is sort of in the most secure position, and then the SBA is providing a portion of the junior piece, if you will, and you're getting a higher return because you're taking advantage of a fairly low interest rate on those other two layers. Is that a fair way of looking at it?
It's a bit different than that, because what the SBA will do is, they provide the leverage for the fund. And so it's across the board on the investments. And the SBA leverage itself is quite favorable. It's interest only for semi-annual payments. So we'll make 2 payments a year, interest only. There's no amortization. It's 10-year paper, so it matches the life of the fund essentially. And then we can pay it down. You have to prudently pay it down as you start getting paid back on your investments. You can start paying back your SBA leverage. And the way it works technically is, initially they give us a draw, and then the interest rate gets fixed a couple of times a year by the SBA. They'll issue at a spread to treasuries, which for a long time has been quite a favorable rate. And it's off the long-term treasury, 10-year treasury. So that rate has remained relatively low. So it's a favorable financing structure for us. And this is a program that's been around for decades. So and the nice thing is also for the U.S. taxpayer is that we don't rely on congressional appropriations. This program is self-reliant, is self-funding.
Terrific. Let's turn to the risk side for a minute. What do you view as the top 1 or 2 risks of the strategy? If someone wanted to make loans like this, and clearly this is not a strategy that a layperson can execute on themselves. It's pretty involved, and you have to have a lot of pieces to put it together. But what do you think would be the main risks that someone in this business needs to think about?
Sure. I think it always comes down to a couple of big factors in credit. You have the private equity firm. We invest in companies alongside private equity firms, and so it's really the experience of the private equity firm. And as JP Morgan says, it comes down to character all the time. And so we're backing a business, but we're also backing a private equity firm. We're backing a management team, and sometimes I've seen things happen with a management team that there's turnover in the C-level officers. Sometimes a C-level officer gets sick or, passes away. It does happen, unfortunately, in this business. So you need to invest alongside a private equity group that you think is going to be willing to dig into it if there's a problem. You can never anticipate some shocks that happened with the business. We saw that in the pandemic, and we worked very closely with private equity firms. So, again, going back to character, they need to have integrity. You need to have a good dialogue with them, and trust that what they tell you is really what's going on. You work together. They need to trust you as well. I think you build a relationship, and you really find out, when things are going well, everybody looks good. But, when you hit a recession or you hit an unexpected bump, that's when you really find out what it's like to work with a private equity firm and with a management team.
Okay, let's talk about your business for a minute and the market that you're serving. Is it a growing market? When you think about your own ability to deploy more capital over time, what are the factors that drive how much you can grow your own business?
Sure. So deal flow is essential, but what we found is that the part of the market that we're in, small businesses, the lower middle market, these are businesses that need capital to grow, and it seems a bit incredible, but as the private equity industry has grown, the need for capital to support private equity, there's the we put the L in leverage buyout, right, in LBO. And so it's essential to provide our capital, our form of capital, debt, to help these businesses grow more efficiently. And, that's why we partner with private equity firms. And so as more companies have seen and that the private markets are able to provide the capital need and they don't need to go public necessarily, the need for our capital has grown as well. And so you've seen that in a lot of growth in different parts of the private credit market. And after the financial crisis in particular, when the banks pulled, of 2008, 2009, when the banks pulled back, the need for private credit only increased because we have more flexibility. We have to be prudent in our underwriting, in our investments. We're still responsible for our investors' capital, and we take that responsibility very, very seriously. It's not just the return, but it's the protection of their capital as well.
So when you win a new loan, are you typically taking the spot that would have come from a particular group of competitors, or is there sometimes that that capital would actually come from a totally different type of source otherwise?
Yeah, it's a bit of both. It is a very competitive market. The lower middle market where we participate is probably less competitive than the multi-billion-dollar, several $100 million and up loans. But nevertheless, it is competitive. There are some terrific players there, with very long experience in the market. And so part of it is we have to beat out a competitor. But the other part is also, where else would this capital come from? And this is kind of the essential part of our business. It's possible that a private equity firm looks at something and says, okay, if we could get a little bit more debt capital on this, it feels like it's going to generate the right return for our set of investors. So, sometimes we say, okay, we can add another couple $1 million there of debt capital instead of having it be equity. Or maybe we do a layer of preferred between the common equity and the debt. And so there's, every deal to some extent is not cookie cutter. We can add some bespoke type of financing structure to it. And what we like to do is say, okay, what does this company need, not just to get the deal closed, but to grow? And that's the part where we can be a bit more creative and say, okay, here's how I think we can provide capital, not just for today, but in the future. Here's the path to provide more capital so that the business can continue to grow.
And then they don't have to go and get a new lender when they execute on their business plan. They can continue to work with you and the bank that's part of your group. By the way, I have a question back to the unitranche and the bank participation. Who is servicing that loan? Is it the bank that's collecting the interest payments and then distributing your portion to you, or is there some other way of servicing it?
Yeah, the payment will go, it's one wire, it'll go to the bank, and then we have an agreement behind the scenes with the bank called an AAL, an agreement among lenders. And basically what that document describes the relationship. When the loan payment comes in, the bank gets their portion, we get our portion, and that really governs the relationship between us. And as amortization will go to the bank, for example, if there's a cash flow sweep, how that's treated. When, you don't like to get into this, but if there's a problem with the business, how is that handled? All that's in that agreement among lenders. But that's behind the scene, and it's a more versatile or easier document to go through than an intercreditor if we were in a senior mezz type of structure.
Okay, so let's switch gears now to you and your career. And if you could just give our audience a brief background about your career and how you got focused on the area that you're lending into right now. That'd be great.
Sure. I started my career, it's been 30 years since I graduated from college. So I started my career on the investment banking side at Goldman Sachs and spent 7 years there and really learned a lot about M&A and financings, equity financings, debt financing, high yield, all kinds of things there. I took a bit of a detour after my time at Goldman, went into the tech sector. Probably not great timing. That was around the time of the dot-com issues in 2000 to 2002. But I was CFO of a wireless software company, and that was a pretty interesting way to learn about an entrepreneurial business. And I really caught the entrepreneurial bug. So I moved to the buy side, if you will, to the credit side and direct lending in 2007. And that's when, at the time in a private fund, then we did a BDC, which is a business development company, which is another form of lender with permanent capital in that structure. And so I've been in the business, we're at a new firm now, but been here about 6 years, since 2016, but, have stayed on the credit side, on the direct lending side, and really in the lower middle market. I really like providing the financing for these types of businesses. When I was at Goldman, I got to work with some big names, household names like Polo Ralph Lauren and Disney Company, but, and we got access to C-level officers, and that was pretty exciting. But on a day-to-day basis, especially now later in my career, I can say I like the impact that my decisions make on these businesses, and I like that these small businesses are really focused on growth, because we're talking about not just for customers, not just for the private equity firms, but growth in these businesses means more employment, more capital in local communities.
What else should our audience know so that they can either learn more about this niche of lower middle market lending, or maybe anything else that you think is relevant?
What's important about this sector, I think it's, a pretty good career path for a lot of folks to get into direct lending, because you see a lot of businesses. You can have a positive impact on, hopefully the business does well and you're able to help it grow. I think that's personally extremely satisfying to know that you have an impact, that you're working with, entrepreneurs, which is something that's always exciting. It's fascinating to see all the different types of small businesses that are out there. And I think it's personally extraordinarily satisfying to be able to have a positive impact on the employee base. And, we take great pride in the fact that, we supported all our businesses. We worked very hard through the pandemic. I sit on a board now for one of our businesses, and hasn't been easy with inflation and labor issues, but, really focusing on that and helping the business grow, helping it get out of difficult times. I think it's incredibly satisfying. And so, I'm 30 years into my career, as I mentioned, I'm closer to the end than the beginning, but I think it's a great place if someone wants to work with entrepreneurs and they're young and, they want to help grow businesses in the economy. I think it's a terrific place to look into lenders, direct lenders, small business investment companies, SBICs, as we're called. I think those are great areas to look for a career in.
Okay. And my last question, which is a question I get a lot about our funds, is interest rates are moving. They're moving up. What does that do to your business model?
Sure. So all of our loans are floating rate. And so we had the philosophy, when we started this, that, hey, we want to be able to give our investors protection on the downside, so we'll have floors on our rates, but also give them some upside in the businesses that we invest in. And we do that with having floating rate loans. For a long time, it really hasn't come into play. The floor has been the most relevant anchor on the rates. But also, the benefit of being a small business investment company and having leverage from the SBA, as I mentioned earlier, that gets fixed a couple of times a year. So in a rising rate environment like what we're seeing, our investors should have the expectation here that they will see enhanced returns as rates step up. Now, it could slow down the deal environment, so that's the other side of it. And it could add to the burden of the companies that we're invested in, because they would have to pay more interest. But that's something that, again, we have to monitor carefully. For our investors, I think it just gives them a good product that gives them a nice return in a regular environment, in a rising rate environment, gives them some upside.
Juan, Alva, thank you so much. I really enjoyed it and I learned a lot. Really appreciate it.
It's my pleasure, Jan. Thanks very much.
I'm Jan Bresky, and you've been listening to Beyond Wall Street.